What's up, everybody? Jonathan Rose, owner, Masters in Trading. Unusual Options Activity. When I was a market maker on the floor of the Chicago Board Options Exchange, market makers would only use unusual options activity to value options. We would be looking at time and sales in whatever names we were making markets, and when big orders came through, we would have to change our levels. So in this video, let's do a short video on how we can find unusual options activity. Once we spot unusual options activity, how can we use it to benefit our trading? Okay, sound good? Give me a thumbs up, that sounds good. And let's get to it. So on Thinkorswim, you can do a scan under Stock Hacker. I just did top 10 sizzling stocks. Top 10 sizzling stocks right up here. Scan, it's going to give me the top 10 sizzling stocks. What are sizzle, or what's sizzle according to Thinkorswim? It's just that there's a large amount of orders on calls or a large amount of orders on the put side. So here, RESI, R-E-S-I, 3325 put sizzle index. So there was an enormous number of puts that traded on RESI. And then if I take you to ticker symbol RESI, we'll see quite a few options traded. This is open interest. The sizzle index is going to talk about volume. You go here, you see volume 22,844. The open interest 22,828. So these were already open. It looked like these were closing. So that gives you an idea. Not every time you see a big number is it a big deal. But traders, you should go through these different call sizzles and put sizzles to see if you can find that unusual option activity. I'll do one more example for you with you. Let's go to the one above it. Park Aerospace, PIKE, P-K-E, up 4.68%, volume 200,000, and so forth. Calls 100 on the sizzle index. Puts, nothing really there. So immediately we would expect to find a lot of these calls that traded on PIKE, P-K-E. Let's go to the chart. Okay, looking around PIKE for a little bit, P-E-K-E, Park Aerospace. We see 145 traded here in August. In May, we see 109.92. In March, now we're starting to get some pretty good volume, but see, nothing on the put side. We look in Feb, only 3 days to go until expiration, so let's not give these too much weight, but they're only doing calls. Now, what does that mean? Could be bullish, right? If they're buying calls, we think it's bullish. If they're selling calls, it might be bearish. Maybe they're long stock and selling calls. Lots of different things they could be doing. So what we want to do is go to time and sales and dig a little bit deeper. What I found was if we go to the big order, which was the 17.5s in March, and if I just go call series, let's only look in March and let's only look at those 17.5 strike, I think what we're going to find is a good deal of them were done first thing in the morning, right? I mean, up to 9 o'clock, it seems like that's when the majority of the trade was done. So if the majority of the trade was done during that time, a cool thing you can do is go and look at a 1 minute chart. I have you on a 1 minute chart just looking at today's activity. And what that's going to tell you is it's going to show you how the market makers hedged. So think of it this way. If the market went straight up all morning like it did, people had a rush to buy stock, the underlying stock. It made the price go higher and higher and higher until everybody was filled. Once they were, the stock came back a little bit. So if everybody was buying stock, what most likely happened was the customer was probably buying these calls as a bullish play or a play for increased volatility. The market makers are the ones on the other side of the trade. the market makers were selling the calls. When the market makers were selling the calls, they were doing two things to their net position. One, they were selling volatility, because when you sell options, you're selling volatility. They were selling calls, they're selling volatility. But the other thing, and the more important thing, is when they were selling calls, they were getting themselves short deltas. As they got short deltas, because they don't have an opinion on the direction of Park Aerospace, they need to get what's called delta neutral, because the market makers don't really care about direction. They're just making markets and trading volatility. So in order for them to get delta neutral, they have to buy the stock, buy the stock, buy the stock. That's why the stock, right after those orders, went from 1620 up to 1660, 1670. Now, speaking as a former market maker, what market makers are going to do next is they're going to be very, very respectful about the upside of PKE. And they're probably going to make the upside a little bit more expensive than the downside. Why are they going to do this? Because they know this guy's out there. And they know at any time he can come in and gobble up a big position relative to the amount of shares PKE trades during a given day. This guy's in control. Everybody else is just making markets around what this guy wants to do, knowing that he's a buyer of volatility and he's playing for the upside. Again, market makers are going to protect themselves and make this stuff more expensive and probably make this stuff a little cheaper. Hope it helps. My name's Jonathan Rose. I'm the owner of Masters in Trading. Thanks so much for listening.